Picture this. It's September 2008, and a single frantic weekend is about to completely change the course of modern history. Inside the fluorescent-lit conference rooms of Wall Street, titans of finance are scrambling, doing absolutely everything they can to avert a catastrophe. But, well, they failed. One massive investment bank collapses, and the entire world economy violently shakes. We're talking stock markets cratering, global credit completely freezing up, and banks just flat out refusing to trust each other. Almost overnight, this shockwave ripped right through main streets everywhere. Millions of people lost their jobs, their homes, their life savings, and the company sitting at the dead center of this chaotic global meltdown, Lehman Brothers. 150 years. For more than a century and a half, Lehman Brothers had survived practically everything the world could possibly throw at it. I mean, we're talking about the devastating depths of the Great Depression, 2 world wars, severe economic recessions, the dot-com bubble bursting, you name it. They were an absolute bedrock of American finance. Yet, despite 150 years of incredible resilience and institutional memory, they met their end in 2008. They literally couldn't survive their own risk. It's just a striking, deeply tragic contrast, right? A long, established legacy, followed by a sudden, total inability to stay alive. Welcome to This Explainer. Today, we're going to unpack the spectacular fall of Lehman Brothers, breaking down the exact anatomy of a financial disaster. And look, this isn't just about spreadsheets and boring market charts. This is a high-stakes human tragedy. It's a story about exactly what happens when explosive growth, unchecked greed, and extreme complexity become completely disconnected from reality. We're going to explore how complex mechanics like excessive leverage, mixed with poor governance and sheer overconfidence, triggered one of the most severe financial crises we've ever seen. So let's start from the beginning.
Act 1. The giant's fatal flaw: overdependence on the housing market.
So for decades, Lehman had built a really formidable reputation for pure ambition and aggressive growth. But right around the early 2000s, they made this incredibly ambitious, monumental pivot. They dove headfirst into the booming housing and mortgage markets. And honestly, it's easy to see why. The math seemed foolproof. Rising house prices plus rapidly expanding mortgages equaled massive, intoxicating profits. At the time, this looked like an absolutely brilliant strategic move. Financial institutions everywhere were basically printing money from mortgage-backed securities, and investors just could not get enough. Lehman saw a golden opportunity to dominate the space, so they invested heavily. They gobbled up mortgage originators and took on incredibly risky subprime mortgages. The money was flowing in so fast, it created this powerful, blinding, and completely false sense of security. But here lies the fatal flaw. Their entire strategy, this whole engine of immense wealth, relied on one single, highly fragile assumption. They basically assumed that American house prices would just keep rising forever, or at the very least that any drop would be a minor bump they could easily manage. So what happens when that assumption fails? When house prices actually peaked and began to fall, everyday people started defaulting on those mortgages, and the value of those massive assets, they dropped off a cliff. Suddenly, assets that once looked highly profitable became completely toxic. When you build that much of your growth around one single market condition, you become dangerously exposed the very second the wind changes. Lehman didn't just have normal market risk anymore. They had highly concentrated existential risk. Which brings us to Act 2, building a house of cards, leverage and liquidity. Underneath the shiny appearance of immense growth and all those record-breaking profits, complex financial mechanics were secretly acting as hidden cracks in Lehman's foundation. To truly understand how they fell, we have to talk about leverage. In simple terms, leverage just means using borrowed money to increase your returns. In the high-stakes world of Wall Street, leverage acts like a massive magnifying glass. During the good times, it magically magnifies your profits and makes your balance sheet look incredibly impressive because you're using other people's money to get rich. But the dark side, it violently, unforgivingly magnifies your losses during the bad times. And leading right up to 2008, Lehman was operating with exceptionally high leverage, stretching themselves dangerously thin. Think of high leverage like climbing an incredibly tall ladder. When you're operating with maximum leverage, you're standing on the absolute top rung. Now, when everything is perfectly stable, the view from up there is breathtaking. You're above everyone else. But here's the problem. Lehman had a relatively tiny capital cushion at the base to absorb any shocks. We're talking just a sliver of actual cash compared to their massive borrowed debts. So that incredibly tall ladder, it's highly wobbly. If the ground begins to shake even a tiny bit, the fall is completely catastrophic. Once the value of their mortgage assets started dropping, that ladder violently tipped. Lehman simply did not have enough built-in resilience to survive the fall. But leverage is only half the trap. The other half is liquidity.
Liquidity means having access to enough actual cash or assets you can easily and quickly sell to meet your obligations, basically having the money to pay your bills. In banking, your day-to-day survival is entirely dependent on market confidence. It's a business built almost entirely on trust. If other lenders and institutions believe you're safe, they happily keep providing the daily funding you need to operate. But if they look at your ladder wobbling and they lose confidence in your balance sheet, that funding can disappear in an instant.
And that brings us to the terrifying, suffocating death spiral. It doesn't happen all at once. It usually starts with a whisper. Worries about Lehman's massive exposure to those toxic mortgages begin to grow. Because of those rumors, counterparties get spooked. They become reluctant to lend, so credit tightens up across the board. Suddenly, Lehman finds itself struggling to get the daily funds it needs just to keep the lights on, and the cash pressure rapidly increases. Finally, full-blown panic sets in, and market confidence completely dies. Nobody wants to be the one left holding the bag. The tragic irony here is that the more people doubted Lehman's survival, the harder it actually became for them to survive. The fear literally became a self-fulfilling prophecy, starving the bank of the cash it desperately needed to breathe.
Let's move to Act 3, the cost of overconfidence, leadership in crisis.
While those financial mechanics were quietly failing in the background, we have to look at the real antagonist of this story, the extreme hubris and overconfidence of Lehman's leadership. You see, in a true crisis, leaders must clearly distinguish between courage and denial. Courage means taking incredibly difficult, painful action before disaster becomes completely unavoidable. It means swallowing your pride, reducing that mortgage exposure early, aggressively raising capital when you still can, or maybe even accepting a humbling buyout. Denial, on the other hand, means flat out refusing to accept that your brilliant strategy is failing. Lehman's leadership was completely blinded by their 150-year history of surviving previous crises. They honestly believed they were invincible. So they waited far, far too long to act. By the time the severity of the crisis was obvious to everyone, their options had dramatically dropped to zero. The root cause of all this inaction really comes down to governance and culture. Risk management absolutely must have real independent authority, not just be some corporate box-ticking function. Inside Lehman, the culture wildly rewarded aggressive growth and risky deal-making. The deal-makers, they were treated like absolute kings, prioritizing short-term profits and huge bonuses over long-term institutional survival. Sure, risk management departments existed, but they were repeatedly ignored, sidelined, and stripped of the power to actually challenge the executives. That is a massive governance failure. For risk management to mean anything, it must be able to boldly challenge leadership, hit the brakes on bad deals, and actually be heard long before the crisis arrives at the front door.
Now for Act 4, the global shockwave, systemic risk unleashed.
By the frantic, desperate weekend of September 12, 2008, Lehman was running out of time, running out of credibility, and absolutely running out of options. Rescue talks with other banks and the government ultimately failed. And so, Lehman Brothers was forced to file for the largest bankruptcy in U.S. history. The shockwave didn't just hit Wall Street. It was an absolute earthquake. It paralyzed other banks, froze global investors, hit insurers, gutted corporate payrolls, and forced entire governments to scramble to prevent a total economic collapse. This perfectly demonstrates systemic risk when the failure of one single, massively intertwined institution threatens to bring down the entire wider system. Nobody knew exactly how large the radioactive losses would be or who would fall next. Credit markets froze solid. It revealed just how heavily interconnected, dangerously leveraged, and terrifyingly opaque modern finance had really become. And Lehman became the ultimate tragic symbol of that failure. Finally, our last act, lessons from the rubble, surviving the unthinkable. The great tragedy of Lehman is that its collapse wasn't caused by one sudden, unpredictable event like a hurricane. It was the result of accumulated strategic errors, a toxic culture, and unchecked greed that finally became visible all at once. As the saying goes, they failed gradually, then suddenly. But looking at the rubble they left behind, we can distill some absolutely critical survival lessons. First, growth without risk discipline is exceptionally dangerous. Second, leverage is a double-edged sword that magnifies both success and catastrophic failure. Third, liquidity matters immensely. Trust is your ultimate survival asset. Fourth, risk management needs real, uncompromised authority to be effective. Fifth, you must act with courage before the panic begins, because delaying drastically reduces your options. Sixth, transparency builds the trust you need to survive. And finally, number 7, absolutely no company, not even one with 150 years of battle-tested history, is too established to fail. Massive risk is almost always built quietly and visibly during the good times. Which leaves us with one final haunting question to reflect on. In any endeavor, the question isn't just about how fast an organization can grow when the sun is shining. The real question is, can your organization survive when the foundational assumptions behind its growth completely collapse? It's a powerful, sobering reminder that risk cannot be ignored just because times are good and profits are high. Thank you for joining me for this explainer. Keep this question in mind and take a long, hard look at the assumptions driving your own success.